Rohit Karni, Managing Director of Roth MTM, and Dan Ives, Managing Director of Bush. It's great to have you two here. I'll start this with you, Dan, since we're seated on the set together. Even though street estimates had dropped and were lower than those going into the print, the business had predicted the 33% gain in Azure going into this. Although Meta's report was good, is CapEx the reason for the stock's current decline? Yes, I would describe this quarter as a huge success for Microsoft. I mean, concerns that there would be some kind of slowness were baseless based on Azure and what we observed in the cloud. You noticed last night's impressive Google figures, of course. This is accelerating for hyperscalers. It's all about the AI revolution, and Nadella is on that Mount Rushmore, not just Jensen. I believe that Microsoft is simply showing off its enormous muscle. In the case of Meta, the stock experienced a significant surge. They will continue to double down on capital expenditures. That's a wise decision, in my opinion. This stock might be up in 24 hours, in my opinion. Therefore, I believe that this is the incorrect response. Considering what we see on Microsoft, we would be buyers here on Meta. Yes, and I suppose that's the general idea I'm trying to convey. It appears like Microsoft's expectations were low heading into this print, whereas Meta's expectations may have been a little higher. I'd like to know what you think about it, Rohit, especially in regards to Meta. I believe that Meta was held to high standards, and those standards continue to rise. I believe Google reported at the top of the Key 4 guide even earlier. That establishes the standard for how the 25% growth algorithm might seem. I believe that investors would have been quite excited if they had been looking for something a little bit more than that. There is nothing at all wrong with Meta. Though I believe it's just a misalignment of expectations between how the stock had run into earnings and what they're pointing towards, it is the one to own on downturn. Therefore, if there is continued weakening toward the end of the year, I believe we should be the ones purchasing Meta tomorrow. Back to Microsoft, Dan. It's only around 1% higher after all. Although it wasn't the highest of the year, you claimed it was a home run. What provides? Is this an indication that the stock may be running low, or are we simply awaiting the color and the guide to determine how optimistic investors should be? I believe it is awaiting that shade from Nadella. However, I believe that this is actually a narrative about Azure growth acceleration. Investors feared a slowdown of some kind. When you look at the margins and that intelligent cloud, you can see that this business is thriving. In my opinion, this represents a $4 trillion market capitalization when we sit here in 6 to 9 months. Apple and Nvidia, in my opinion, arrive first, but the AI revolution is still in its early stages, based on what we have heard from Google and Microsoft and what Meta will say. I believe that the hyperscalers give you increasing confidence. At this point, Microsoft seems like a table pounder to me. Hey Rohit, I'm going to quickly turn left here and inquire about DoorDash. CFO Ravi Ananda will be here shortly. You seem neutral to me about it. It outperformed the street in terms of both top and bottom lines and guidance. Over time, the stock has risen from its lows. It first fell by roughly 5%. It is currently down around 1.5%. Additionally, GAAP profitability. They claim to be growing market share and have a cooperation with Lyft that, I assume, aims to compete with Uber. What else are they supposed to do? Look, I believe they are in a good position because they have the best and most lucrative market, which is the core market. There is already competition in any new area they enter, whether it be grocery stores, restaurants abroad, or any new expansion. As a result, the profitability of these new growth areas will be structurally lower. That is our concern with DoorDash. It leads the market for restaurants in the United States, but as time passes, their profitability will decline in all other areas they deal with. Profitability in the GAAP is crucial. It is most likely the only firm with a market capitalization of $60 billion that announced a GAAP profit in its first quarter today. Once more, I believe that one of our main concerns is valuation. We are neutral because of what I believe will happen to this company over the next 12 to 18 months, as growth slows to the mid-teens and long-term profitability will not be as high as that of a standalone mobility company like Lyft or a global leader like Uber. All right, Dan Ives and Rohit Karni. Furthermore, it's possible that the enterprise side of it, which we're not necessarily hearing about at this time, will benefit more than the consumer side. However, If the hyperscalers decide not to spend as much, it would be good for them, but bad for Nvidia, Tim. Yes. Indeed, I believe that a certain dynamic has fueled Nvidia's earnings and enabled the street to predict the company's performance for the upcoming quarter. However, Google is a wonderful example because they're kind of caught in the center of this, so I do think it gets back. I believe we want to know the return on investment for their investment. Like everyone else, they are curious about the cost and return on investment. After that, you return to their primary consumer business. Their primary search is clearly dynamic and may be in danger, but it is still anticipated to expand. The EPS line is expected to climb by about 13.5%, and I believe the street is at a consensus of 12.4%. Based on the multiple relative to itself, this puts Google in a position where it should be the most protective of all these stocks. Again, if it's trading at 20 times, this is a $200 stock at the EPS where the street is, and I find that to be interesting. How has the positioning been going into this crucial earnings week, Em? Optimistic. Actually, in almost all of them. Yes, indeed. First off, Nvidia traded 4.7 million contracts today, out of a total of 55 million contracts, including options for index and exchange-traded funds. In all of these names, calls are exceeding puts, and by a significant margin. It's likely that there will be twice as many bets on the upside. I believe it's more a matter of being cautious about how far the stocks have come, with Nvidia perhaps being the most prominent example. What multiple we attribute to this, I suppose, depends somewhat on your expectations, but for the entire year 2025, I'm looking at maybe $4 per share. That means we'll reach 35 times next year. With a PEG ratio of less than 1 and more than 40% annual growth, that doesn't look like a lot of money. That's growth at a fair cost. How about semis? You know, when we brought up Nvidia, Apple was right at the top of the market capitalization chain. Although it has undoubtedly had an amazing run, not all of the stocks in this market are Nvidia. How do you evaluate the semifinals? This is the one instance when I believe you have witnessed leadership truly fracturing or splitting, and this has been the case throughout the spring, summer, and fall. Both the Nvidia chart and Broadcom's performance are well known. Applied Materials, where are they? Lam Research is where? Where is ASML? Samsung, where are you? It is, in my opinion, the quickest of those that are regarded as leadership. Under the surface, it is the weakest. Here, only a quarter of the semis are above their 200-day moving average. Over the next 4 to 6 weeks, semis do provide some decent seasonality. If you had a bounce, I believe I would be more likely to fade it rather than chase it in the semifinals. I questioned you about Berkshire selling Apple earlier, so now I'll ask you about Nvidia, its participation in the Dow, and your thoughts on it in light of your observations over the years. Yes, obviously, on some level, the Dow felt a little out of step with the current state of the economy because Intel had been included earlier and Nvidia, which accounts for 7% of the S&P 500, had not been included. One could argue that it is simply clinging to a high momentum play after its biggest gains have already occurred. I was just examining the market capitalization comparison between Nvidia and Apple, which is currently neck and neck. Nvidia will receive almost half of the net income and a third of the revenue in the upcoming year. It is evident that the stock is more costly, but its growth rate is significantly faster. First of all, just because a stock is listed on the Dow does not provide you a fresh incentive to purchase it in the near future. That's not a good incentive to buy, according to history. Not much money is indexed to the Dow. Instead, it focuses mostly on confirming its present position in the emerging IT sector, which we sort